And it was them calling and said, if you were serious about buying RFT, we'll sell it to you. Are you still interested? Yes. Was the price you're willing to pay still the price? Yes. Okay, sold.
Wow.
That's how we got that done. And that turned out to be, that was a $600 and something million commercial mortgage REIT. It is now $6 billion.
Wow.
And the fourth largest publicly traded commercial mortgage REIT.
Special episode of the Deal Ranch podcast. We've stayed within the Franklin Templeton family a couple times now. So Rich Byrne, president of Benefit Street Partners. You guys are an amazing alternative credit manager nearing $80 billion under management, which is a big deal. And this was a referral from Tony Davidow, who we had on over winter. So excited to chat with you, Rich. Thanks for coming on the show, and thanks for hosting me here in the brand new building.
Yeah, thanks, Matt. Thanks for having me, and hopefully I can do Tony's recommendation justice.
I'm sure you will. Before we go back through your career and how you wound up here at BSP, do you want to give an intro and kind of 30,000-foot overview of BSP and your current role here, just for frame of the conversation?
Sure. Yeah. Benefit Street Partners is, as you said, about an $80 billion asset manager. We're a credit asset manager. You mentioned alternatives. Everything we do is credit. So we either lend or we buy loans, or most of what we do is we make loans. Credit for us is in corporate arena. So we do private credit. It's a really hot category these days, direct lending. We lend to mid-sized corporations, mid to larger sized corporations. We have a liquid credit on the corporate side business, where it's broadly syndicated loans, high yield bonds. We typically do that through CLOs. We're one of the 10 largest global CLO managers in the world. We have a distressed business. And then separate from that, really very similar in so many ways, is real estate credit. That's about 11 billion of that 80 billion. And probably the best relative value opportunity today. Of all those strategies.
But I think we'll talk about that quite a bit, maybe a little bit later in the show. I listened to a couple other podcasts, like you said, that Megan had shared, and it seems like you have no shortage of stories. But do you want to talk about your earlier days in your career, kind of what you were working on, your first couple jobs, and then it sounded like maybe there was a 14-year mark for you between all of the jobs. But so tell me where you started and then how that shaped your role to get into this credit space.
So I like that you said that about 14 years because it's true. My career is really easy to follow. I've only worked at 3 firms, at least since graduating from business school. I worked at Merrill Lynch for 14 years. I've worked at Deutsche Bank for 14 years, and I've been at Benefit Street Partners now for 12.
Wow.
So hopefully I have more than 2 years left. Either that or I'm going to have to find a new 14-year job. Right. In my early years at Merrill Lynch, I first worked in equities as an equity sales trader. I eventually moved, it was in Chicago, I eventually moved to New York to be one of the founding members of the high yield research department. Wow. And, earned my early stripes as a high yield research analyst. But back in those days, it wasn't such a defined, constrained job. You got to be on Monday an investment banker, like on Tuesday you got to be a trader, and on not specifically, but you got to, do those functions. You could be a research analyst maybe on Wednesday, and then on Thursday you'd be a salesman or capital markets guy. Wow. It was such a dynamic job, and it helped me learn all aspects of the business. The sectors that I followed, a bunch of sectors like textile and apparel and retail, but where I sort of made my mark was in casino, gaming, lodging sector. Where really got deep into those days, had some really high-profile clients, like maybe you've heard of them, Donald Trump.
Once or twice.
You may have heard that name. But other, real high-profile guys like Steve Wynn.
Wow.
And, just lots of characters got to encounter over those years.
So were working with him when he was doing the Atlantic City casinos?
Yeah.
What did you work with him on specifically?
So I would say Donald was my client, our firm's client, but specifically mine, for close to 15 years, spanning, most of my time at Deutsche Bank, at Merrill Lynch, and then subsequently Deutsche Bank.
Okay.
Worked with him on financing of multiple of the casino properties, and then one big deal at the end of my time at Deutsche Bank was to clean up most of the mess that had been created because, a lot of, not necessarily the deals that we did, but a lot of his casino debt had defaulted, and it was kind of a big hot mess, and came up with a trade to sort of clean it all up, to repay debt that was otherwise defaulted and flush it out with a new holding company debt, which succeeded. Was a real big win for him back then.
What was it like working with him, being so closely over 15 years? Did you see him evolve? I mean, he's been in a plethora of different businesses, and now, as our president...
So, Matt, this is kind of funny. This happens in every conversation. Yeah. Now it's happening with you, is we're on a topic, and as soon as Trump's name comes up... all the other questions go away.
I wasn't trying to pigeonhole you there.
No, that's okay.
Interesting time period.
No, that's okay. He incredibly dynamic. Just as far as his superpower is just being famous. Just holding people's interest. People just want to follow him. They want to believe. They want to be close. And using that, I was quickly figured out. I'll tell you the secret sauce that we used. So when we were doing this, what I called cleanup trade, it was a big deal at a holding company level for, to sort of repair the damaged balance sheets out of various properties. And it was very difficult to sell it because a lot of the people you were going to raise capital are the people that probably owned the earlier bonds that weren't doing so well. And it was, he kept a positive attitude through the whole thing. And I don't want to take up too much time with this story, but this is a good story. Yeah. So we went around and created roadshows. And for a person in my seat, I'm sort of, remember I said I did different roles. This is like called a capital markets role. And for a capital markets person, it's kind of easy to manage your client when you're doing a roadshow. Why? Because when you go to, first of all, do you get good meetings? Do a lot of people show up at the lunch and you get a meeting at Fidelity and Putnam and all the big managers? Because if you don't, they kind of know it's probably not doing that well. Right. But if you do, that's a good sign. Then it's on them to perform. So then you go to the meeting and you could pick up body language when they're asking questions that you can't really answer or they're showing skepticism. None of that stuff happened. He got every meeting at every big firm. And not only that, this is before he's a politician, he's just a famous guy. And it was even before The Apprentice.
Wow.
Yeah. So, I mean, think about it. He was great at being famous for like 4 or 5 decades.
It's crazy.
Right? So famous that we'd go to Fidelity, we'd have to have the meeting in their auditorium. Usually you go to a conference room with the 2 analysts that cover your company and you have your meeting. They would go to the auditorium and I think there were 20 people there. And this happened at every meeting. So naturally he's thinking my deal's a home run.
No.
And then nobody would ever ask him a challenging question. And then he would give these answers and he would exaggerate and all this. So the meetings were fabulous love fests. But then the salesman would call for the reconnaissance. So, hey, Bob, that meeting went great with Trump. Are you going to be in the book? And they would look at him and they would say, no. Are you crazy?
Oh, no.
So as far as managing a client's expectations, can you imagine that?
Tough one.
Great meetings, tons of meetings, all the right people.
No interest.
But no interest. Yeah. So I think this comes under the never give up. And if you think hard enough, you can come up with a creative solution of how to get this. How were we going to get this done? I was refusing to take no's. And this was the trade he needed to fix, the balance sheet. And it came up with the answer. by asking ourselves this one question. What was his superpower? Well, we saw his superpower. It's, get. And so we had him come in and only meet with our salesmen. Bonds aren't, what do they say? Bonds aren't bought, they're sold. Mm. So sometimes your best sale is the salesman, right? So we had him come in and he schmoozed the heck out of the salesman, made him feel like $1 million, and was inspired at the end to tell them, hey, fellas, I know this isn't going that well. It's kind of hard. If you get this deal done, I will take you to Mar-a-Lago on my plane as my guest for the weekend.
Wow.
So the salesman went into turbo drive.
Wow.
And I don't know how they did it with bubble gum and spit and glue. They somehow put this deal together. The deal got done. And I'll never forget it. Donald said, was very thankful. He knew that it was hard. And he said, that's great. He said, I said, Donald, don't forget what you promised. He said, oh, they won't remember that. I said, won't remember it. It's all they've spoken about for the last 3 weeks. And so we did it. And he loved it. He took us to Mar-a-Lago.
Oh, really?
And to this day, I'll reunite with any of these guys. I mean, this is a long time ago. Yeah. This is 25 years ago. I'd reunite with any of these people and say, oh, highlight of my life.
Wow.
Going to Mar-a-Lago and doing that trip. So anyway, I hope that answers your question.
It does answer
a slight
the question.
Detour in our
I know
conversation.
Megan wants us to talk more BSP, but we'll get there. So rounding out your career, leading us to BSP, so spoke about that big client there, so to speak, but what else did you learn through those roles? And then what was the transition to Deutsche Bank?
Okay, so at Merrill Lynch, I was, as I mentioned, a research analyst. Mm-hmm. I eventually moved up in the corporate ladder. I ended up running research and fixed income research and our high yield group, then fixed income research, and then eventually became co-head of the global leverage finance business, and ended up leaving to go to Deutsche Bank to take on a similar role. Okay. The former head of fixed income at Deutsche Bank was a guy named Edson Mitchell. He tragically passed away years later in a plane crash. But he had tried to recruit me and my boss at the time, Tom Gann, and we kept telling him, Deutsche Bank too small. They had been spending a lot of money. They bought Bankers Trust, and the day they bought Bankers Trust, Edson called and said, "Are we big enough now?"
Right.
And long story short, yes, went over there. And they had a storied history, Bankers Trust did, in leverage finance. Deutsche Bank had spent all this money for all these, stars to populate these departments. And they kind of needed somebody to decide who was going to be in the starting lineup, because they had full rosters from Deutsche Bank and Bankers Trust. And who better than a guy from a neutral third party, because if it was a Deutsche Bank guy, he'd pick all the Deutsche Bank and so on. So it did that, but then expanded that role, ran global leverage finance, ran global capital markets, took on the financial sponsor coverage group, which was a great experience because back in those days, the private equity firms kind of ruled the world, and we were a major financing source for them. And eventually became CEO of Deutsche Bank in the U.S., the broker-dealer called Deutsche Bank Securities, which was the U.S. arm of Deutsche Bank. And then I left in 2013, but in 2008, towards the end, at the worst bottom part of the market, Tom, the guy I mentioned, left with a couple of other folks. And I was going to go join him at the time. And being the CEO, I really just couldn't leave. There was so much dealing with regulators and I needed to get my 14 years in. So I stayed, and they started Benefit Street Partners. And about 4.5 years later, I joined.
What was their original focus in 2008? Also peculiar timing, starting a credit business during that time. So what was Tom's original focus? Were they all 6 strategies that you currently have, or what was the focus in 2008?
Had one strategy. I wasn't there, obviously, but I had one strategy, which was to take advantage of all the dislocation in the market
Wow.
And because these weren't necessarily bad credits, they were a dislocated, broken market during the global financial crisis. And Matt, I swear, if people don't remember so well when they remember their own predictions, they usually remember them better than they were.
Right.
But I think if you polled more than 5, 6, 7 out of 10 people back at, in October of
2008.
Was the market going to zero, or was it going back to where it was? I think 6, 7, or 8 of them would have said zero.
Right.
That's how bad it was. And Tom and team sort of saw that as an opportunity, that the markets, may not be right away, but the world will correct itself. Buy good businesses. If you can buy bridge loans at 60, 70, even 50, 40 cents on the dollar, and you had the right collateral and the right everything, you were probably doing well, because the banks, this is a professional term, were puking them out at the time. They just needed the free up regulatory capital because they were worried about having to take government money. Some were worried about going out of business. So being a liquidity source for people that had to get rid of inventory was a pretty good business model. Wow. And killed it. They killed it. It was great timing. It was perfect in retrospect. The only problem was, that is not a way to build a business. That's a way to start a business, because that opportunity obviously was pretty short-lived.
How did they raise money for the acquisitions or buying those loans early on? Like, was it tricky for them to do?
So the first partner Benefit Street Partners had was Providence Equity. Providence Equity Partners.
Okay.
I didn't want to say the word partners so many times,
okay.
but Providence Equity Partners.
Yeah.
Providence, I don't know if you're familiar with the name, but they were a pretty high-flying private equity firm back in the day. They specialized in media and communications. And Tom, when he was starting the business, wanted to partner with somebody that could help him get access to capital. What would have been the worst thing in retrospect in October, 2008, to have to go be searching for money.
That's what I was curious about.
Right,
yeah.
As opposed to having money. So they had an ability to carve out 10% of their private equity fund. I think it was a $12 billion fund. So that was $1.2 billion to go put to work right away.
Wow.
Weeks later, they went to some of their key LPs in that $12 billion fund and said, do you want to do a separate fund? And I think they raised another $1 billion or $2 billion for the same opportunity. Wow. So that's $2.5–3 billion, plus they use some leverage to go exploit all these broken bridge loans, and just killed it with that. I mean, most anybody that did at that time, but the beauty of Tom, and why I would have loved to join at the time, is that we knew everything inside the engine of every one of these loans, because Deutsche Bank was one of the largest lenders. So a lot of them were loans that either Deutsche Bank was in, maybe they bought it from somebody else, but Deutsche Bank, we knew it because we had extended the loan, or we passed on it, or we represented a different buyer for the business and we lost, but maybe the other guy won, but we had files of information on each loan. And in their heads, I mean, they didn't take the files with them, but in their heads, they knew each one. They knew which were the right loans and which were the wrong loans.
Brilliant.
Yeah.
This episode of the Deal Ranch podcast is brought to you by Hux Curry Advisors. Hux Curry Advisors is the complete real estate consulting and advisory firm in the Myrtle Beach market, providing the services needed for any stage of your project, whether it's strategic planning, site selection, due diligence, project management, land planning, or anything in between. If you're an institutional investor looking to expand with a strategy, a small business transitioning from renting to real estate ownership, a landowner seeking maximum return, or a national retailer searching for a key location in this top growth market, reach out to Hux Curry Advisors for all real estate consulting needs in the Myrtle Beach MSA. To learn more about Hux Curry or connect with the team, go to huxcurryadvisors.com by clicking the link in the show notes. So then what was your transition? Now we can kind of fully shift into BSP. So you came in 2013. I know you said you kind of wanted to join in 2008, but it wasn't the right time. What made it the right time, and what made you interested in 2013 to make the transition?
So in 2008 through, 2010, my job had gone from being the co-head of global capital markets to be the co-head of dealing with the SEC, FINRA,
Fun.
Every other regulator that we had actually issued badges to dozens of staff at each of the regulatory agencies, just were free to go in and out of the building, just looking. I mean, they were literally getting paid to find problems. So
wow.
When that's your motivation, you tend to find problems. So anyway, it just took a while. I'm proud to say that all these years later, despite the fact that Deutsche Bank, I think, had the first or second largest leverage finance portfolio, bridge portfolio, never took a dime of government money.
Wow.
I mean, it didn't mean that we didn't have issues, but we sort of worked through them all. And I think it's one of only 2 banks that didn't take government money. So very proud of that. And that's sort of
a huge deal.
Where I had spent a lot of my time, kind of fixing what we had built. And did that. And, I had a lot of clients and a lot of people that I felt was kind of difficult to leave. But eventually, when I did hit the 14-year mark, I wanted to get Benefit Street Partners had gotten to build up some steam. It took them 4 or so years to do it, and built out strategies that went far beyond that original, distressed bridge loan business, and built out a direct lending business and a liquid credit business in bonds and loans.
So they had those 3 strategies at the time, and they were, from what I read, somewhere around $3.5 billion or 3.4.
That's right.
$80 billion today. It's a big difference, and that's over 12 years there. So what is then the growth journey when you come in, and did you step in right away as president, or was there another role you were in when you joined?
No, I stepped in as president, and I am quick. And I'm glad we can share this with all your viewers to point out that we went from $3.4 billion to $80 billion.
It's crazy.
While I was there. But my partners are quick to point out that if you read anything about starting a business, the first $3 billion is the hardest. Right?
That's right. Yeah.
Most firms don't even make it to that.
Of course.
They don't last that long. They did the hard part. Was their
Starting
point. Yeah. But no, it was an incredible journey. I started, and my role, in the beginning was, and maybe even to today, was strategic, thinking about strategic directions for the firm, what strategies to undertake, M&A. We made a number of acquisitions. I think the most successful firms, you look at the Blackstones, Apollos, all these firms that have been successful, they've succeeded because they're really good at what they do, but they also filled in with acquisitions, oftentimes because they have inexpensive currency to buy other things, because they have high valued stocks and stuff. And we did the same. We made some key acquisitions. We built out a permanent capital part of our platform we have a BDC. It's I think the 7th largest BDC. We have publicly traded commercial mortgage REIT. If we're going to talk about real estate, we'll talk about FBRT, our commercial mortgage REIT. So some of that stuff we built out by acquisition. But, my role is more strategic, M&A, fundraising, and, generally running a business.
What do you think what were the biggest acquisitions or most pivotal acquisitions in building the company and bridging that delta of $77 billion there to where it is today?
I know you don't have a 5-hour podcast, so I'll try to keep my answer short, but this is a really good story, another good story. I'll give you the short version.
No, you take your time.
So the best by far is buying the one I said, the BDC and a mortgage REIT. So there was a manager called American Realty Capital. They were the biggest and best by far in the retail channel of raising capital. They called them non-traded REITs. Their specialty was real estate, was REITs, and they had built out some monster. I mean, they were the best. But they had gotten into some legal issues at the parent company, and we approached them and said, "Listen, you have a BDC." Which you raised, but BDC, I know that's not really your business. I know how good you are in real estate, but not really. Would you consider selling that to us? And anyway, one thing led to another. It took a long time to find the price and negotiate the deal. We negotiated a deal, and that became our BDC today. We grew it. we turned over the investments multiple times and merged it with a sister BDC that we had raised. So we parlayed that into something much bigger. But you needed that snowball to start getting down the hill in that acquisition. But the best part of the story was, while we were negotiating, it took months because BDCs are regulated under the Securities Act of 1940, and the voting requirements to get those proxies just take forever. Right. REITs, for example, are way quicker. And they had a REIT. They had all these property REITs, or net lease REITs, but they had this one REIT was a commercial mortgage REIT. It was called RFT, Realty Finance Trust, and it was small. It was $700 million. For them, that was small.
Was it a new product for them?
It was.
Or
it
just
was
something that
it was
didn't
a
grow?
REIT that they had raised. The way their capital raising goes, yes, it was new in that they had never done a mortgage REIT before.
Right.
But they got it up to $600-700 million of capital raise, and then they had these legal issues. And the way the curve works for raising capital is, you spend 2-3 years getting all the selling agreements and stuff, and then in that last 2 quarters, 5-6 months, you raise all the capital.
Right.
So they didn't get to that last part yet. They got to 700. They probably would have gotten it to $1.5 billion or $2 billion. It was sort of stillborn. 700 is still acceptable size, but it wasn't what they had wanted. And but it's in the real estate category, but it's a mortgage REIT. They never did lending before. They did property REITs. So I had always said, RFT, if you want, we could buy that too. No, we'd never sell that. We'd never sell. So anyway, long story short, one of their lenders pulled their credit line, and it was in distress.
Okay.
And I'll never forget, I was out paddleboarding one day, and like once a summer, you get the ocean is flat enough that you can take because I'm not that good, and you take the paddleboard out, and I accidentally left my phone on. I was listening to music or something, and it was them calling and said, if you were serious about buying RFT, we'll sell it to you. Are you still interested? Yes. Was the price you're willing to pay still the price? Yes. Okay, sold.
Wow.
That's how we got that done. And that turned out to be, that was a $600 and something million commercial mortgage REIT. It is now $6 billion.
Wow.
And the 4th largest publicly traded commercial mortgage REIT.
Wow. So that one played a nice little role.
That was a nice role, yeah. So sorry for the long story, but I thought it was
a great
worth
story.
it. Yeah.
And then that rate, we can get to in a second, but there was a new acquisition, new point in there recently, right? That's going to be, seems like a pretty big deal and should really shake things up for you in a good way. So digging in a little bit more into modern day BSP. So you have these 6 different strategies. You introed them at the beginning, but which have led to the most growth, recently in the last 3 or 4 years. So we've had this rate environment, we've had increases, we've had COVID, kind of a very wild credit time with swings here, which have been the most impacted by in the last 3 or 4 years of those strategies.
So all that has gone on in the markets, all that volatility they mentioned, you have to keep in mind a broader perspective of since, let's say, 2009, when our story started earlier, the markets have been just really placid. In fact, just slightly going up a little every year, risk premiums. And very undifferentiated, except for 2 very short periods. One was during COVID, of course, and that was fairly short-lived. And the other one was now, back in 2022 when rates started going up. So other than that, we've been in actually a pretty tame credit cycle. We actually live for periods of dislocation because you get the differentiation.
Delta.
You get opportunities to differentiate yourself. The easiest answer to your question is the product du jour that everybody wants to talk about is private credit or direct lending, corporate direct lending. That's about 25 billion of our so let's call it almost a third of our AUM.
Wow.
It's probably the thing we're best known for because right after back in the story I shared about, the start of Benefit Street Partners, the first strategy we kind of embarked on was private credit or direct lending. And we built out a real good expertise in that. That's what our BDC does. That's what our private funds do. We have separate accounts. We even have some retail products. That's all anybody wants to talk about now. I used to go to conferences, all the time, and you sit on these panels, and I wanted to talk about direct lending, and then they'd go through all their questions, and maybe if they had 3 minutes before they got the hook, they would ask a question. Now the panels are called direct lending or private credit.
Yeah, exactly.
Yeah,
right.
so that's what everybody wants to talk about. So that certainly has fueled a lot of the growth in our platform.
What strategies were impacted the most during the COVID period? When I was doing my prep for this, I'm like, I wonder what changed during that period. Which strategies were most impacted during that time, do you think?
All.
Okay.
Probably direct lending the most, but it was for a very short period of time. A real estate lending business as well. I mean, it's hard. I'd have to think hard about which was worse.
Sure.
We got a lot of modification requests for just to get grace periods on interest payments,
of course,
and covenant relief, and it was really tough. I think we had a very focused, longer or intermediate or longer term outlook that this wasn't going to be a 2, 3, 4 year thing. This probably would be something that the economy would start getting on its foot a little quicker. And we were willing to make, modifications,
of course,
and grant other leniency on credit documents, just to help
keep
our borrowers get to the other side.
Wow.
Yeah.
As far as real estate goes, generally a real estate podcast, tumultuous time in the market right now, but where are you guys, and this we can pivot to FBRT, but where are you guys seeing the opportunity now, especially in the credit side when cap rates are low? Kind of how would you paint the picture? What's your analysis of the current market right now?
So the market in real estate has gone through an incredibly tumultuous period. I in one white paper we did, we compared it to a hurricane, sort of like a Category 4 hurricane.
Right.
Think about it. When rates go up that much that quickly, it affects values of all assets. But corporates are more nuanced. You have a market share and cash flow, and maybe you have the pricing power to offset some of the higher costs of your capital structure. Real estate is much more straightforward.
100%.
If your cap rate goes up, your property value goes down, and interest rates are highly correlated to that happening. And so when rates go up that quick, property values. So I don't care what your property was. It was an office, it was a
whatever.
It was a shopping
Retail,
center.
Yeah.
It went down just because of the math of rates, 20 to 30%. When rates go up from near zero to,
what they are now.
Yeah, what they are now. So think about it. A loan, even to the best property, assuming that property didn't have just incredibly dynamic rent growth, that it offset that, but an average property, you would lend somebody money, and I'm not talking about office now because office has its own set of problems, which we can address, but you lend somebody money with, let's say, a 65 LTV on that loan. Well, mark that property down, pick your number, 25%, that LTV is going to be in the 90s.
Yeah, that's a good point.
So is that loan, are you going to lose money? Is that loan a default? Maybe, probably not, on average,
right.
But your margin for error is now very small. And what we're seeing now is all those loans trying to get to the other side. A lot of them get modified, a lot of them get extended. And, so we're just seeing that. And it's causing a lot of people a lot of heartache. And the last thing I'll say is because a lot of those loans, a lot of these loans are shorter term. In corporate world, all the loans made in 2021 when money was free, those are generally like 7-year loans. In real estate, a lot of these transitional loans are 3 years.
Yeah.
So this is all upon us now. So there's this giant digestion period taking place in commercial real estate. But that doesn't get you to a Category 4 storm. That's maybe a
2, 1?
Yeah,
whatever.
maybe a 1.
Yeah.
What gets you to category 4 is office. It's that of $6 trillion of real estate loans out there, a quarter of all those loans, so $1.5 trillion, whatever that number is office. It does, the banks have office, the regional banks have office, the private funds, the REITs. Just office is the problem. And office, as you know, is not dealing with a down 25% problem. I mean, maybe the best ones will. Yeah. Some of those are going all the way to zero. So, when you factor that in, there's a world of hurt that a lot of the legacy portfolios are feeling.
To jump into two things on the back half of that, how has the loans in your funds, how is their performance affected by these massive rate hikes? On one hand, if they're variable rate, it seems like it obviously would be beneficial, but then also did delinquencies go up with the higher rate for people? So what's the net value or gain or loss in this big rate hike for a player like you guys?
So let's take office off the table for a second. So just let's say we have a portfolio, 75% of our book, roughly on average, over time is multifamily. And we generally like to think about Class A or high quality Class B, recent vintage, Sun Belt, good properties where people want to live. So good properties.
And where is this located? This is in FBRT and then also in some SMAs as well?
Yeah.
Okay.
Our real estate platform, we have a number of vehicles, and we, depending on the property and the size and whatever, we could co-invest across our different vehicles. So, across our various strategies, I'd say we're pretty consistent in our focus on multifamily.
Got it.
Right. So, not generally, almost without exception, every new loan we make, we require the borrower to put in a rate cap.
Oh, okay.
Right. So, and the loans are typically, give or take, 3 years. They usually have some extensions. But when rates go up that much, those 1-year extensions are all out of the money. They're not, so it's really a 3-year hard maturity loan.
So you require a rate cap. And
yes.
then how many basis points do you think that is? Like, what do you require? Is there a certain amount?
No, that'll cap. Yeah, I mean, we required them back when rates were zero. So, they're still, during the time that rates went up, they're still living under the, 2021, rate world, which is great, except those hedges or the caps are coterminous with maturity. And, your loan matures in 2024 or 2025, that goes away. So that's when the conversation gets more interesting. Because remember I said, you had like this 65 LTV. Yeah. It's not a 65 LTV anymore. No. The property's worth less. And now you're, to refinance, you're going to have a higher cost of debt. So the borrower is either going to come out of pocket. Some of these
to put new equity in the deal.
To put new equity in the deal to then size up your new, let's say, 65 LTV loan is going to require them to put in $10, $15 million. Some of these are syndicators. Maybe they don't have the money. All of a sudden, like Warren Buffett said, when the tide goes out,
see who has no shorts on.
You see who has a bathing suit on, right? And you quickly figure that out. But if you think about it, if you have a high quality property with your 90-something LTV and you put it out, and let's say they hit their business plan, it's stabilized, you put that in the market, you're going to do pretty well. I mean, on some of them, maybe you'll lose a couple of bucks, but you might even, on the winners, you might even make, above your basis. So taking deed in lieu and taking possession of some of these properties is if we can do that, I mean, it's a lot to deal with, 150 loans in our book. But, if you had to do that on all the loans, I think your outcomes would be great. And, all the worst fears of the street would be quickly rest assured because you'd have...
For you guys, if you had to take the property back.
Yeah. And going into a negotiation around a modification, that's a pretty strong hand because you say to the borrower, hey, listen, I know you're an eternal optimist because you're a real estate guy. Real estate guys only think of the positive. Rates are going to go down. The world's going to get better. I get it. I know you want a modification, but unless you're bringing your checkbook to that conversation, why would we do that? We can get out of this loan and get all of our money back. So unless you're writing a check to buy down my basis, we're not even talking about a modification. Right. So I
It's a
feel
good
like
negotiating chip.
yeah, so there's three doors. Either they're going to pay off the loan, they'll put in some more money, they'll get the money from somebody else, maybe you'll do it. Mm-hmm. They'll pay off the loan, they'll modify the loan because they're making the loan better, or we'll take over the property and sell it. And that's what we've all, not just FBRT, we've all been dealing with for the last almost 2 years, is clearing through that 2021 and before vintage of loans to get to the other end, because the current vintage of loans is off the charts good. Yeah. Because think of it, you're lending now that 65 LTV off of stuff that's 25% lower.
Right, exactly right.
Right.
What is the standard modification that people are doing? Just bringing in new equity, or are there any creative terms that you're having to work out deals with? Like, what's a standard, or what are the series of different modifications that people are looking to do?
There's a couple of different versions of this, but I think the simplest version is they want time. And they will give you what you need, what you're, within reason to get more time.
So just bridge?
And so, equity to buy down their basis is the number one ask that, we would want, because
decrease your risk profile.
Decrease our risk. We'll usually ask them to put a rate cap in at the current rate, because, and then there'll be all sorts of other conversations around, other modifications to the loans. But usually it's a 1 year conversation, and a year later you go revisit it, which brings me to another interesting point. The street used to always talk about this 3-year debt maturity problems. It was, people used to talk about $2.5 billion of debt maturities coming due. It was like $800 million per year, roughly. And we used to talk about that last year. And 24, 25, and 6, it was about $1 billion. It was about 2.4 trillion. Well, now we're looking at 25, 26, 27, so it's a different 3 years. But now it's over 3 trillion. It's most of the 3.5 trillion. Why? Because the vast majority of all the loans that were supposed to mature in 24 didn't mature. They got pushed out. Yeah. And there's a difference. What I described is an amendment. It's a acknowledge and address, as we call it. You acknowledge your problems, you address them, you either sell the properties or you modify them by enhancing the credit. But there's another type of modification. What do they call it? Pretend and extend?
Yeah, pretend.
Yeah. That's when you're kind of SOL on your property, and maybe the lender just doesn't want to take it back, and it doesn't want to acknowledge that a problem, so it just extends the maturity. So I want to just make sure we're delineating between the difference. Two. One's a economically sensible, and the other is just to avoid, disclosure.
Yeah. So that was my next question on the back series of that stretch. So people have been talking about for years, all these commercial mortgages are going to mature. So now we're seeing it parsed out over the next 3 years. What do you think that ends up looking like? More opportunity for folks in credit, or is it going to be catastrophic for some folks? Like, what does it end up looking like? I'm
going to turn that question upside down on you and say it this way. For all the people that are still caught in this pretend mode, they're frozen. They can't really make new loans because they're hoarding liquidity right now, because they're going to eventually, especially on the office problems, they're going to eventually have to true up these loans, and they're going to have to put in more capital. They'll have to buy them off of their warehouse facilities or buy them out of their CLOs, and that's going to cost money. That needs liquidity. Remember, you were asking me about COVID before. Right. Several companies went under, a lot of the residential mortgage REITs. A couple went under and a couple nearly went under. And the biggest reason was liquidity, not having the liquidity to deal with problems that turned out to be very short term. If they had just had that liquidity, they'd all be alive today. And I think people, oddly, because people have ADD about these things, they learn their lesson. Yeah. So my answer to your question is most of the traditional lenders, especially the regional banks, are not lending right now. They're hoarding their capital. Yeah. So the opportunity lies in, we're now out making loan proposals on loans that we used to have, everybody and their brother bidding against us. And, right now it's wide open field because so many of the traditional lenders have backed off because they're frozen. So that's the opportunity.
Well, and I feel like they're asking to bring, hey, you got to bring a lot of deposits over to our bank, and it's like 50 LTV. It doesn't seem like people are willing to do those loans with banks. Maybe, I don't know.
And I would differentiate between regional banks and money center banks.
That's right.
That
was more of a regional bank.
Yeah, I don't think the J.P. Morgans and the Citibanks and the Bank of Americas, they have a giant business model. They may have some real estate, some office loans that aren't doing too well, but in the scheme of things, they'll probably be just fine. The smaller regional banks, that's a bigger cause for concern, right?
How frequent does the deed in lieu process happen? And then what is that process? How do you guys handle actually, instead of just having credit or paper extended, now owning assets? Is there a division that will handle the sale? And what is that?
Yeah, I think this is an important and very often missed point when investors are choosing a manager. Because, being an investor in a private market, an alternative credit product, whether it's direct lending or real estate lending, you're not buying a bond that you could buy off a screen. And, if you decide one day you don't like it, you just sell it on the same screen. You own these things. And, for our real estate book, we're typically the only lender. In our direct lending book, for example, we sometimes are the only lender. Maybe we'll be in a small syndicate of 2-3 other firms. So we're kind of stuck with this stuff. So needing, having the asset management capability, because everything isn't going to go exactly according to business plan. We built a business around assuming that it's not, hopefully the vast majority of the time, of course it will. But when it doesn't, we want to have the capability to fix a problem, to take over a property and run it. There's two ways, especially for a good multifamily property, that'll happen. Either because the property will be stabilized, the business plan has been hit, in which case we're probably, the extent of our asset management skills will be hiring some brokers and selling the property.
Right.
Still, that's not necessarily easy. It's still work to do, but you're not running the property and making all sorts of, you're caretaking the property. On the other hand, there are cases where property didn't, still has, it hasn't hit its occupancy numbers. It hasn't hit its, rent roll that, you want to see. You're not going to maximize your sale price until you achieve these benchmarks. And we need to go figure that out and do that. And thankfully, we have a very deep team that has had a great track record around, fixing, taking ownership and owning it and fixing problems and being a property manager.
Wow. So are any of these in like some portion or going through a stretch of a heavier renovation that you have to jump back in, and reno still needs to be done for the rents to be released or restabilized? So it's like probably a small multi-office, like a traditional multi-office, or people that could do that, I would say. Right?
In some cases, I would say anything office, probably no. But for multi, typically the transitional business plan doesn't involve any kind of heavy work. It's more light touch. It's painting a lobby and, maybe countertops. And a lot of it revolves around the operating model of marketing and, repositioning a property, getting the right sales team. And a lot of it's that, but it's all the above. It depends on, where you are in the life cycle.
Okay. I want to ask one question before we spend a little bit more time on the fund side. So in growing or over this 12-year journey while you're here so far, what do you think at the business level or at the leadership level for you was the most challenging time? Or two questions. What was the most challenging thing that had to be done? And then what was the most challenging, market cycle that you experienced?
Oh, well, I've been sort of out, in the professional capacity for almost 40 years. So I would say, as a general rule, my 12 years at Benefit Street Partners, I wouldn't put anything in that super challenging category.
Even growing the business, like expansion.
It's been a labor of love, and I think people that work here really, like to be part of a winning team and want to be growing. And a lot of it's just come in a really good organic way. Our acquisitions have been embraced. I think we've done things that had, where people came along with the deals, where there were similar cultures and a lot of that. Maybe the most challenging And I don't think it was, in retrospect, I really don't think it was very challenging. But the most disruptive was our sale. We didn't mention it, but our firm was sold to Franklin Templeton. That's about 6 years ago now. And that's a pretty big deal.
Can we talk about that for a second? I had that on my list I wanted to chat through. So what was the origin of that? They've obviously we're in their building right now. We fortunately had Tony on from Franklin. We've had some folks from Clarion as well. So they've been on this alternative acquisition spree in a way. How did that come about with you guys at that time?
So it's a really organically good story.
Okay.
We were partnered with Providence. It was sort of like think of it as a partnership. We own roughly half of the business. But they have a private equity mentality. They always look for an exit, right?
Yeah.
And, we knew they kind of were thinking about that. And Benefit Street Partners probably had grown way either equal to or well above their expectations. So they had a good monetization on their minds. Also, we had kind of outgrown them. We were... at the time we sold 6 years ago, I think we were bigger than Providence.
Oh, wow.
Yeah. And what do you want your owner to have? You want them to have distribution capabilities, capital, and access to things you can't access yourself. So we thought about a partner. We didn't want to put ourselves up for an auction or the most important part was not the proceeds. Because a lot of the proceeds were going to somebody else anyway. The most important part was fit and ability to leverage that fit and grow beyond that. And we had a couple of bilateral conversations, but then ended up getting introduced to Providence through a board member who Tom and I were very close with from Deutsche Bank, who was on the board.
Got introduced to Franklin?
Yeah.
Okay.
Yeah.
Cool.
He was on the board and said, hey, you ought to meet with the Johnsons. This could be a really good fit. And we flew, long story short, after a trip or two to California and talking about things, what they said was what they wanted a presence in alternative credit. And if they knew how to do that themselves, they would have done it. In other words, we're not going to tell you how to do your job. Yeah. You run your business. Because we didn't want to lose the entrepreneurial spirit of being a 200 and something person firm and, having all that. But what they were able to bring to the table is capital, distribution, and especially in retail, where we didn't have any distribution capabilities.
Oh, wow.
And access, and information and access, which they've been so generous with providing to us. And it's been a home run. I know you hear all these war stories about acquisitions and all the things you couldn't anticipate or whatever, but, literally no surprises. I think if you ask most of the people that worked for Benefit Street, 3 months after the acquisition or a year or 3 years after the acquisition, they would say, yeah, nothing in my life changed. Yeah. Oh, I have a new health plan. Oh, I have to fill out a new form for that and whatever. Yeah, but otherwise, day to day, it's Benefit Street Partners with a giant assist on any heavy lifts, from Franklin.
What was the so the main purpose of the equity, or what was the equity used for? Was it just expanding funds and putting our new acquisitions for you guys?
No. Most of the equity, the price that Franklin paid was to buy out.
Oh, buy out them, right? Of course.
And then to distribute some capital to the partners, and a lot of that was in the form of an earn-out over time.
Got it. You used that as your answer to the challenge question. You said for most of the people at the company, it didn't change much. For you, was it a big lift now? They have obviously this huge alternatives platform you probably had to be plugged into, or maybe your funds are a part of. What was the transition in, I guess, jumping into that world with them?
So the transition to that world is I personally and several on our team have spent a lot of time with Matt Nichols, our CFO, and trying to think holistically about this growth strategy, whether it's at BSP or elsewhere across the platform. Franklin has been pretty acquisitive. Yeah. Lexington Partners and lots of acquisitions that builds up that alts platform. So we've certainly thought about the world in that perspective. But I don't know. Strategically, it's about trying to find the right fit within the organization. Because when we make an acquisition, typically, we're using the help of Franklin's Capital.
Yeah.
And I can give you several examples. For example, I talked about the success story of that small little REIT we bought that became FBRT.
Yeah.
Well, one of the ways that happened was we went public through a reverse merger. We ended up buying a publicly traded residential commercial REIT called Capstead. And we reverse merged into Capstead, the successor company being FBRT. But we had to pay we paid stock to the Capstead shareholders,
right.
But they wanted a premium to their price in order to be induced to sell. There was an auction and they wanted money. Franklin ended up footing the bill for the vast majority of that premium because they didn't want to dilute the existing FBRT holders and wanted to facilitate the deal. So that's just like a great example. Then after we went public, Franklin sponsored a $35 million share purchase program to help support the stock because, as soon as you go public, there's going to be some illiquidity and people are going to want to sell. So they've been super supportive. So we like to think of it holistically. This is all part of alts. Mm-hmm. We want to grow alts, and we want to grow it intelligently. Doubling the size of your commercial mortgage REIT and having it trade well is certainly a pretty good use of your capital.
Yeah. In lightly wrapping up, or at least to save some time, I want to give you some time to talk about any specific fund in particular if we want to, or if there's any deal story that you wanted to cover in general. But as far as FBRT goes, it seems like there's a new acquisition of NewPoint recently. Mm-hmm. Can you go over the impact of what that will play? Because now with this agency exposure, I was reading in maybe one of your articles, it seems like a nice parlay between your current bridge loans in there and then maybe getting those into some longer-term products. So do you want to go over the NewPoint acquisition and what role that's going to play?
Yeah, absolutely. I'll give you the shorter version. Yeah. So FBRT, just to level set for everyone, FBRT is a commercial mortgage REIT. We make the loans that we've been sort of referencing. We make transitional loans. That's our balance sheet business. We lend money, floating rate loans. We have a portfolio of about 150 loans, and we earn it's an income generating vehicle in the form of a REIT. So it's got this favorable taxation. REITs are great, but I think commercial mortgage REITs are a really interesting, good business. That's why we did it. And people think of them as income vehicles. So we pay a 9+% dividend yield at the current price. That's closer to 10.5 or 11, and people like that income. But the problem is the book value. It's hard to grow the book value. In fact, when things go wrong, the book value could actually go down. And I think that's the knock against commercial mortgage REITs is that you'd like to have capital appreciation in addition to that income. This should solve that problem. This solves many other problems, but I wanted to start with that. So I mentioned, have a specialty in multifamily. Mm-hmm. We think that's the sweet spot of the market. It's what we've done well and we've leaned into for all these years. Well, after we make a transitional loan, aspirationally, what our borrowers want is the exit for that transitional loan. They want to have executed their business plan, stabilize their property, and then they don't want this floating rate short-term money anymore. They want a nice federal government permanent financing at a low rate for 10 years or potentially more. We couldn't provide that.
So what were they doing now after that? They would just exit and find someone else.
They'd find somebody else to make them that loan. There's only 19 licenses through the Freddie Mac, Fannie Mae, that are out there on GSE-sponsored entities that can make these loans, and we bought one of them. So now we can sort of cradle to grave. We can even do a construction loan leading to potentially, we don't do a lot of them, but we can do a construction loan leading to this transitional loan and then provide the takeout.
Wow.
That's a full cycle. They have originators at NewPoint that originate these these agency loans. We have originators that originate the transitional loans, but there's no reason that the originators on our team couldn't also do the agency loans, especially since their own properties that are getting these, and vice versa. Wow. So we think the synergy value is incredible. But the reason I mentioned the book value opportunity is because we're also, when we originate an agency loan, we're putting on our balance sheet something called an MSR, a mortgage servicing right. And those MSRs have real value. And the way the accounting method works for them, that value, accretes over the years. And if you're making loans and you're growing the book and the loans are good loans, you should be able to grow your book value. So it's more stable income, it's the synergy value, and it's the potential to grow your book value. Wow. And it's a game changer because now we don't look like all the other commercial mortgage REITs. We look like something a little bit different. Yeah. And I think it's up to us to sort of prove that out. You can't just make an acquisition and expect everybody to understand your story. I think it's now on us to prove out those synergies and that book value and all that.
Well, now it's almost vertically integrated for any part of the lending process that you need if you're an operator on any of those deals. Last couple questions for you, Rich. So how do you decide with all of these different vehicles that the company has, some being separately managed and then some being publicly traded, how do you allocate when a new loan comes in? I saw a hotel maybe, trying to think, Empire Hotel. How do you divvy up where that gets, and how does that get spread across different vehicles?
Good question. We have a very legally carefully vetted allocation policy across our platform. This applies to direct lending. This applies to real estate, anywhere where we have more than one fund that could invest in a given loan. Typically, the way it works, although it's far more nuanced than this and it's formulaic, and on the corporate side, you need exemptive relief, and then for some of our real estate loans, you do as well. So this is SEC-blessed allocation process. We, typically, if the loan is big enough, that loan could be shared across your platform. So everybody gets, and the bite sizes will be based on the size of the fund or the available capital in the fund.
That makes sense.
Right. And then there's all sorts of exceptions and other rules based on whether it's a legacy loan or maybe it's a smaller loan. There's lots of little, nuances and ways to deal with things that are off the beaten path. But as a general rule, the allocation policy, there's no decisions we have to make. The allocation policy does it mathematically.
Okay. Last three questions. So what is the team focused on now, just broadly speaking, kind of in this current time? Where is your focus? Where's the team's focus?
So, of course, we spend our time in all of our strategies. As I mentioned earlier, I think the best relative value we're looking at right now is commercial real estate, commercial real estate lending, for the reasons that we discussed. So let me answer the question on real estate. It's funny because you asked what other funds we have. Well, we have an opportunity fund. We have another fund that on the retail channel that maybe defines the business a little differently. And we have our FBRT, our publicly traded mortgage REIT, which is the most plain vanilla. It really just invests top of the capital structure, like 99% first lien loans. Yeah. So despite the fact that we have the ability to go for a little more juice in the other vehicles, they're all investing about the same way right now, which is just top of the capital structure. It's just too easy to hit a single to induce you to try to stretch for a double or triple or home run. We're making loans now at SOFR, on average SOFR 400 and something, with a little leverage that our vehicles use. That gets us to like a teens return at 65 LTV off of properties, as I mentioned before, that are 25% marked down. So that's like a 50 LTV off of like the 21 value. We just think that's hard to beat. Like you can get enamored with like some mezz loan at 10, 11, 12%, but now you're looking at 90, 95 LTV, like this 65 LTV with a little leverage just seems like the best risk reward. So And I think our investors appreciate that we're not getting too carried away, in the current market, because the market's very attractive right now.
You guys have expanded so much and have so many different strategies, but is there a service, a fund, any product or market that you're not in? New Point obviously gets you somewhere new with the agency lenders, but is there anything you guys haven't done or that isn't done with Benefit Street that you would like to do in the future? Or that would complete maybe the overall service offering or product offering?
Yeah, of course. But I think there are little backfillers. In real estate, I think New Point did it.
Okay.
That we have a commercial real estate conduit within our REIT. We have an opportunity fund. So, we do some construction lending throughout. I don't think there's a commercial real estate lending product that we're not well represented in, us according to the opportunity. Right. On the commercial, on the corporate lending side, I think we have a pretty built out suite as well. Some of the hot areas today, in addition to direct lending, are asset-based lending. A lot of people have been talking about that, some infrastructure and some other things. We have an asset-based business and an equipment financing business within our BDC. So we are represented in some of those product categories, but not more broadly across our platform. So, of course, we're always thinking about best risk return, best relative value.
Right.
Do we do this organically? Do we look to buy somebody? So we're always having those conversations internally. But I hate to sound complacent, but it kind of feels like we're sitting pretty good right now.
It's a good thing to say. Last question. You've had an amazing career across these three great businesses here. Who do you think, as it pertains to just business, or has helped you the most in your career? Who do you think you've learned the most from, maybe throughout your journey? Any mentor in mind, or anyone that you spent a lot of time around that you think you learned an exceptional amount from?
Wow, that's a really good question. I've had some really good partners, some really good bosses. One of my best mentors and friends and partners has been Tom Gann, who I mentioned, the founder of BSP. He built, and we built together, a bunch of businesses across both Deutsche Bank and Merrill Lynch. I think if there was somebody I've learned the most from, and because we have sort of complementary skill sets, it's probably been Tom. But I'm going to give you a wacky answer, and I appreciate it because every time I ever do a podcast, the podcaster loves to ask me about my jiu-jitsu career.
I know you own a jiu-jitsu promotion company as well? Or?
Yeah, I do. That's a fun part of my life. But I had a mentor who was my original jiu-jitsu coach.
Yeah, I think I heard that you work with John Danaher or something, which is crazy.
Yes, yeah. And he's had an incredible impact to this day on my life, teaching me jiu-jitsu, but so many life lessons, attached to it.
Wow, that's crazy. Anything we missed, Rich, in wrapping up? This was, I think, super comprehensive. Hopefully we hit on everything here. It was great to have you, and thank you for hosting. But is there anything we missed about your story, your life, or BSP that you wanted to finish with?
No, I think we covered it pretty well. In the event my wife or two daughters listen, I want to point out that they're the loves of my life, and right. You need a reason that you're doing all this, and being part of having a family that's been great like that has been terrific. But other than that, no, I think you covered things really well.
I appreciate it, Rich. Thanks for coming on the show.
Thank you.